Sorry, folks, I'm having a little challenge with the technology here.
Are you trying to get it full size, Kerry?
Yeah, I'm trying
down.
to get it.
Yeah, down below where it says 71%, kind of at the bottom of your screen. Oh, there you go. Okay, look at you. All right, we're good.
All right, everybody. Yeah, it was on my end. For some reason, it's frozen. Well, good morning, everybody. And Mike, thank you for this introduction. And welcome, everybody, to a special meeting here on Good Friday. If you're religious folks, this means something significant. Otherwise, it's just another Friday for the rest of us. So anyway, appreciate this chance to spend a few minutes with you. I'm going to share with you a presentation that I've shared with folks from AIM in the past. We did it in October last year. We did it in January. But I want to take this opportunity today to really focus on a couple of things that are helping with the sale of Liberty Life's estate maximizer single premium whole life product. So this may be a refresher for some of you, but it will also give you an opportunity to maybe ask some of the questions that you didn't ask before. Maybe you have a little bit more knowledge today or over the last couple of months that have put you in a situation where you've tried to prospect for a client for this particular product, or you have had a conversation with clients and have had some questions come up that maybe we can answer for you today. So that's one thing that I'd like to do as we go through our presentation today. I'm going to talk a little bit, just high level, again, about some of the features of the product, but then I want to spend most of our time today talking about the qualifying questions. What do we see in comparison with the questions that we ask compared to what you might find if you were asking for your traditional long-term care? And we're specifically, again, going to drill down on what questions we're not asking. And then ultimately, I do want to spend a few minutes on the benefit, the Liberty Living benefit that talks about the accelerated benefit in case of terminal illness and chronic illness. I want to go back over those features because those are the ones that your clients usually want to know about. So if we can, let me just kind of take us through a couple of these slides real quick. I'm going to skip over the first couple of slides about the drill bit and just, again, just reiterate who Liberty is for your clients. We've been in business as a life company since 1963. We're celebrating actually our 50th year this year, so we're having a big celebration at Liberty Life, and you may have seen us in our sponsorship of the Olympics in this last Winter Olympics 2014. We're going to do it again in 2016. So talking just a little bit real quickly about the highlights of the program. Just a reminder that this particular single premium whole life has a minimum deposit of $15,000, and we have maximum limits of single premium that we will accept based on age. And those ages are broken down on the slide that shows minimum payment, maximum payment for simplified issue. One thing I do want to make mention here, these are the limits for simplified issue. Ages 50 to 59 will take $100,000, 60 to 64 will take $175,000 max, and 65 to 80 will take $225,000. And you see there's a little cliff there that age 81 to 85, it drops off down to $40,000. Again, remember, the reason why these limits are in place is because we are not doing any underwriting. We're simply not. We're doing an MIV check against what the client or the applicant tells us on the application, and that's it. So our net amount at risk has to be manageable for us because we're not asking a lot of health questions, and that's why these limits are in place for simplified issue.
Hey, Kerry, if you change that, there you go to the bottom one. Perfect. Okay.
I got it. So in the situation where this is simplified issue, I do want you to know that Liberty Life has this single premium product available up to $1 million of single premium pay, but those contracts would be fully underwritten. But on a single pay basis, we will take a larger amount than these that we're showing on the simplified issue screen. So I just thought I'd insert that. I don't believe I mentioned that last time we had one of these calls. As true to all life insurance contracts, whole life insurance and UL and whatever, you have the opportunity to withdraw money. In our situation, after the first contract year, if a client wants to withdraw money for a short-term need or short-term emergency situation, they certainly have availability to their cash value. We will allow them a 10% withdrawal after that first contract year. without any withdrawal charges, and if they exceed the 10%, then there's a withdrawal charge that becomes effective. You can see it's a graduated scale from 4% down to 2% at year 7. And then there's a couple of situations where we will actually waive this withdrawal charge. We'll talk about those in the event of terminal illness and chronic illness. But the whole story behind this particular product that I want you to be aware of is it's all about liquidity and access. In your line of marketing with long-term care products and so forth, clients have a typical concern that, what if I need my money? Can I get at it? How liquid is it? What kind of penalties am I going to have to pay? What loss am I going to experience if I surrender one of these kinds of things? And so that's where the story here is, that there's cash value in the contract that's available by the way of withdrawal in the event of short-term access. And then we'll talk about some of the other features of how longer-term needs might be accessed as well. The living benefit rider is a free rider that's included in every one of our contracts unless the client specifically asks and waives not to have it. So it's not one of the situations where you have to sell this particular rider. It's automatically included. And the rider is specific to terminal illness and chronic illness. Now, you'll see that we will allow an accelerated benefit of 90% of the death benefit. So if you can picture in your mind 3 different columns that we're going to talk about during my quick presentation today. We're going to talk about the premium and the deposit. We've talked a little bit about the cash value access already, and now we're talking about the death benefit, and it's 90% of the death benefit that's available in the event of a terminal illness or chronic illness. But we retain a residual of $10,000 minimum in the life insurance contract if this particular rider is activated for terminal illness or chronic illness. And the reason why we keep the $10,000 minimum in play on any life insurance contract is so that the contract doesn't lapse. If the contract lapses, then we've created for the client unnecessarily a taxable event. And that taxable event is called phantom income, because when a life insurance contract lapses after accelerating benefits or extinguishing all of the loan and withdrawal value, then everything that's been taken from the contract becomes taxable if that contract lapses. So we don't want that to happen. In the event that we have one of these claims, terminal illness or chronic illness, we want to make sure we understand the definition. Terminal illness, except in the state of New York, is that the client has been diagnosed to be terminally ill with 24 months of life or less to live, and chronic illness is the inability to do 2 of the 6 activities of daily living, and that condition is chronic and expected to remain for the remainder of their life. So when we have these types of claims, these are not like hip fractures or I want to say a pneumonia where they would go into a nursing home situation and then come out. So chronic illness, the definition of that is that they're unable to do 2 of these 6 activities, and they're expected to remain that way for the remainder of their life. All right? So we'll talk a little bit more about this 90% and how that all comes into play. People often ask me, well, what is the actual number? What is the number? Say, for example, a client had a $100,000 face amount contract. How much are they going to get? Well, we could go through the actuarial table, but not only would that be frustrating to a lot of people, but specifically frustrating to clients to go through that. It's the same as if you tried to go through the actuarial calculation about how cash values or dividends or some of those things were calculated. What I simply want you to understand is that we take the death benefit, we take 90% of the death benefit, there's a $100 administrative fee, and then there's an interest discount that we apply because we're prepaying the death benefit. We subtract some of the interest up front on a discounted basis. We subtract some of the earnings from that amount that we would pay to the client, and it's that amount after the discount is applied because of the accelerated benefit. That remaining amount is what's paid to the client. So it's not as easy as taking $100,000 and taking 90% and then the client gets $90,000. It's not that simple of a calculation, but we don't want to make it more complicated at the point of conversation than it really needs to be. Simply tell clients, we're going to take a $100 administrative fee and we're going to apply a discount. Now, for those of us here on the phone today, that discount is based on a rate, and that rate is based on what's going on in the marketplace with long-term treasuries, T-bills, those kinds of things associated with the market. That specific rate applied for the last 6 years has been 4.6%. Okay? So we would apply a discount of 4.6% after the 90% and minus the $100 service fee, then we would apply the discount. If a client takes a lump sum, which most of our clients do, that's a pretty easy deal to work with. Some of our clients want to stretch these payments out over a period of time, which they can do, specifically in the case of chronic illness. People might want to stretch that out for a year or two or whatever. So those discount factors apply over that number of years. All right? Something else about the chronic illness rider that you want to keep in mind is some of that chronic illness payment could be taxable. And it could be taxable if it exceeds the 101G IRS code for the amount of money that can be taken on a daily basis / monthly basis. So if it exceeds the $320 a day, $9,600 a month, if their payment were to exceed $9,600 a month because they stretched it out over time, then any amount over that IRS code limit would be taxable, just like it would be in a regular traditional LTC. Okay? So there's a situation where you need to be aware of what portion is taxable, and it might be a simple reason to persuade your client how long they want to take the money out, or maybe perhaps if there's a time of claim, to take the money out lump sum. Something also interesting about this chronic illness benefit and or the terminal illness benefit is we only validate the reason for claim at one time. So in the very beginning, if a client is unable to do 2 of these ADLs, a year later we don't ask to recertify. A year later we don't ask to recertify again and again. Once claim has been activated, we proceed with claim. So it's a very low intrusion kind of a situation, and that's why, again, most clients are willing to go ahead and take a look at taking lump sum money. We pay the money directly to the client. We don't ask for any type of receipts. The money can be used for care of any kind, not necessary for the client to be institutionalized in the event of chronic illness, but they do have to be certified by a professional health care provider that they, in fact, are eligible for the claim. All right? So I want to talk a little bit more about some of the other highlights of the liquidity. Liquidity in this case includes the 100% guaranteed return of principal, anytime, any day of the week, any year. So if a client takes out an estate maximizer and puts in 50 grand today, 8 months down the road, 2 years down the road, 8 years down the road, they can change their mind and always get 100% of their principal back. Now, that's great for the client, but what I want to help you understand as producers is that there is a chargeback to producers in the first 2 years. So this is not a product that you want to persuade a client to take money out of a CD and put it in here for 6 months and see what happens with CDs, and then they can jump out and jump back into CDs. In the first year, there's a 100% chargeback of commission to the producer. And in the second year, there's a 50% chargeback to the producer. So you need to be aware and be careful that if you're going to recommend this particular product as a wealth transfer solution for your client with liquidity, that they have to understand, or you have to understand, you shouldn't share this information with them about your chargebacks. You need to understand that this is something that they want to be in for the long haul. Okay? So we have a guaranteed death benefit. The amount of premium that the client puts in specifies the death benefit from day 1. That death benefit does not change from day 1 to year 121 of their age. Whatever that death benefit is on the day they buy it is the death benefit it is at whatever time death occurs. Okay? But it's a guaranteed death benefit, and the cash value in the contract has a guaranteed cash value credit of 3% minimum. And that's what the current crediting is 3%. We had a rate adjustment, I think, a year ago where we adjusted the rate to the guaranteed level of 3%. But that cash value can increase. The crediting rate on the cash value can increase, but it will never be less than 3%. So we've talked about the accelerated death benefit for terminal and chronic illness. We can speak some more about that. We talked about the waiver. Let me talk about the waiver of withdrawal charges in a minute, as they apply to these terminal illness, chronic illness situations. We talked about partial withdrawals, and I want to just share real quickly that there is loan provision available. The loan provision is that in the first 10 years, there's a loan interest rate of 5%, but there's a crediting rate, as I just mentioned, inside the contract of 3%. So you have a net loan of 2%. After the 10th year, we reduce the loan interest to 3%, so that the loan rate is 3%, the crediting guarantee rate is 3%, so we have a wash loan in that particular situation if a client is taking loans against their contract. Now, the cash value in this type of a contract, because it's really designed for wealth transfer, it's not designed for cash value accumulation. It's designed for wealth transfer. So this is not a conversation you're going to have with the client about how quickly their cash is going to grow in the next 5 or 8 or 10 years inside of this life insurance, like you might with a UL or a VUL or an interest-sensitive indexed UL or something like that. This is a wealth transfer vehicle. It does build cash value in that the amount of premium deposited will grow in a cash value situation so that the cash value equals the death benefit by age 121. The cash value will equal the death benefit by age 121. But you'll see when you look at a value statement or an illustration that that cash value really doesn't begin to grow beyond the premium deposited until about the 7th, 8th, or 9th year, depending on age. And then it begins to accumulate from there. So if a client is talking about accessing money before the 7th, 8th, or 9th year, they're really talking about accessing their principal because that's what they deposited. So they will be getting access to their own deposit. And in doing so, they can make a choice. Do I want a loan, a withdrawal, or do I want to surrender my contract? Because that amount's going to be the same, maximum limit, up to the first, like I say, 7 or 8 or 9 years. But they're going to pay a withdrawal charge if they withdraw more than 10% in that first 7-year period of time where there's a withdrawal charge. So just keep that in mind. Lots of heavy information I'm going through now, I realize that. So as we take a look at things to compare this with, CDs and annuities, obviously life insurance carries the last 2 benefits of being income tax-free to beneficiaries and having the immediate increase in death benefit based on the premium deposited. So if you're in a conversation with your client and they say, well, I want to leave my money in CDs and I want it to go to my kids, or I have my money in annuity and I want it to go to my wife, or I want it to go to my kids or my grandkids, we want to be able to show them that that's not such a good tax situation for the person receiving the money. The life insurance, the estate maximizer, would be a better place to take that CD or that annuity and to make a single premium deposit into a life insurance and get the immediate power of leverage out of that life insurance by doing so, and also giving them access then to 90% of that leveraged value. So where $50,000 sitting in a CD, if a client were to become terminally ill or chronically ill and needed that money, they would get $50,000 minus an early surrender penalty for taking the money out of a CD. If it was in an annuity and they wanted to get the money, again, they're going to get very little growth out of the money compared to what their deposit is. And again, in the event of a terminal illness or chronic illness, they may have to pay a surrender charge to get their money out of their annuity. Whereas with an estate maximizer single premium life insurance contract, we're going to give them 90% of that death benefit as access for their needs in regards to terminal illness and chronic illness. So it really makes a better story to understand that not only does the money go tax-free to the next generation, there's a leverage amount available in case of those situations. I'm going to skip this consumer slide, which everybody sees in every presentation across the world. How many people are turning 65 every year? About 10,000 of them every day starting this year. So our ideal customer for this single premium whole life estate maximizer is between ages 60 and 85. They're retired or nearing retirement, so they can see the horizon on whether they have some type of an asset that they're going to be able to use to transfer to the next generation. And here's a little catchphrase I'd like to share with you. When you're speaking with your clients, and I know you do a good job of finding out where their assets are, specifically if you're selling long-term care, you need to know that. If they have assets set aside to take care of long-term care, and if you can persuade them to see the value in a long-term care policy as leverage for that need. So I know you're asking these kinds of questions, but what you need to ask the client is, do you do you have money that is for living only, or do you have living and leaving money? Do you have any leaving money that you plan to leave to your children or your grandchildren that you hope you never have to touch, and that's where you would like it to go? So that phrase of living money, leaving money makes sense to your clients. They can see the difference between I'm still taking income from my asset and I'm going to need that income, or I have a portion of my portfolio that I am taking income from, but I have another portion of it that I probably won't have to touch. And that's the money that will become useful to you when you talk about this estate maximizer next generation single premium wealth transfer vehicle. So again, people who are renewing CDs, people who are receiving required minimum distributions from their IRAs. Now, I wanted to share a discovery with you that I came across last week. Typically, when you're talking about long-term care needs in the sales that you're doing, you're talking to clients who are 40, 45, 50, 55. You're trying to get them at those younger ages when the premiums for long-term care are really reasonable and manageable. But when you're looking at the clients who are 65, 70, 75, and 80, those clients don't usually want to have those long-term care conversations for a couple of reasons. One, if they needed it, they probably would have bought it if they believed in it. Two, if they look at the premiums in these higher ages into long-term care, they get discouraged because the premiums are too high. Three, they're not really sure they're going to need the long-term care even if they buy it. And four, they may be looking at this saying, hey, what are the rates going to increase to if I buy one of these contracts? So in this older age of 60, 65, 70, 75, and so forth, using an alternative like a whole life contract where they have access in the event of terminal illness or chronic illness, or loans and withdrawals if they need other short-term money, this may be the perfect solution for them because it answers all of those questions. And when we get to the underwriting, you'll see that that makes real sense. So one of the biggest factors in making the sale, if you find out that they have leaving money, is to really find out where they're connected with that money. And we have to do that in a couple of ways. We have to do that by having this yellow pad conversation or napkin conversation with them about where their money is going to go when they're done with it. And so I typically draw these three circles on a piece of paper, and I write in these three circles L, O, C, and G. The LO stands for loved ones, the C stands for charity, and the G stands for government. And then I literally turn the pen to the client and I say, you know, your money's going to only go to one of three places: loved ones, charity, and government. The good thing is you can decide for the most part where that money goes. But of these three, which would you least like to get your money when you're done with it? And so I have them cross out the G because G represents taxation. If possible, the client can eliminate the government from the scenario where their children and grandchildren get the money if they choose to use life insurance to do it. So we say to them, you know, where would you like your money to go? Or better yet, where would you least like it to go? And they cross out the G. You continue the conversation. You say, okay, so that leaves loved ones and charity. Of these two, which one are you most inclined to leave your money to when you're done with it? Well, I like to leave it to my loved one, they might say. All right. So then you ask this real kind of tongue-in-cheek question. You ask, you know, if you really want your loved ones to get your money and you have an opportunity to see what benefit it plays in their lives, why don't you give it to them now? Well, it's a tongue-in-cheek question because you and I, here on the phone, we already know what that answer is. We know that they don't want to give their money to their loved ones yet because they think they might need it. At which point we pursue the conversation a little further and we ask them, you might need it for what? And they say, well, I might need it for emergency. I might need it for medical expenses. I just would feel comfortable if I had access to my money. At which point we continue our conversation and we say, if we could show you how to pass an enhanced legacy to your loved ones or your charity on a tax-favored basis when you're gone and still allow you full access to your principal and growth in case of emergencies while you're living, would you be willing to look at a financial vehicle that does that? That's your conversation into how you present the estate maximizer. Because when they say, well, yeah, what is that? Then you say to them, I have this wealth transfer vehicle that only takes 5 medical questions to qualify for, and if you qualify for it, then we can show you the power of leverage on how you can increase your legacy to your next generation. And it's, you don't have to go through all the bells and whistles of everything I've given you today, but you can simply let them know and we use the vehicle of life insurance to do that. But you only have to have 5 medical questions to see if we qualify. So I'm going to share with you a couple of what-if scenarios, and then we'll get to the medical question part that I want to spend more time on. So Mary's 67, and she has a CD, and the CD is worth $59,000. She wants it to go to her granddaughter, Jenny, but she has that same thought in her mind that everyone in her age bracket has. What if I need my money? So we show her the estate maximizer, and we show her the liquidity. We show her that she has 100% guaranteed return of principal at any time, any day of the week, any year. We show her that when she has cash value in this contract, if she needs a loan for something on a short-term basis or a withdrawal, she has 10% access to a withdrawal anytime without withdrawal charges, and if she needs more of that, then there's a minor withdrawal charge. We also show her that in the event she becomes terminally ill or chronically ill, she can get up to 90% of her death benefit amount, which in this particular case is a guaranteed death benefit of $100,000. So now Mary is not leaving a CD to Jenny for $59,000. She's leaving a CD to Jenny tax-free of $100,000, and Mary herself has access to 90% of that in the event that she becomes terminally ill or chronically ill. So think of this in your mind. Have you helped Mary? Absolutely. Have you benefited Jenny? Absolutely. She's going to get almost twice what Grandma wanted her to have. Okay? Have we harmed Mary? Does Mary have access to her money? Yes. Is it as liquid or more liquid than she had in her CD? Yes. So here's a situation where we have bettered everybody in this scenario all the way across the line. Okay? Second situation is Ben and Betty. And Ben and Betty are looking at finding out what they can do because Betty didn't qualify for long-term care. And they're a little concerned about that. They're concerned because if they have a resource or an asset available and they put all the money on Ben, what would they do, heaven forbid, if Betty became terminally ill or chronically ill? So in this particular scenario, what we do is we buy a life insurance contract estate maximizer on Ben. And whether Betty is the beneficiary or not, here's the cool thing about this. Because Betty is Ben's spouse, if Betty were to become terminally ill or chronically ill, we would allow access to Ben's cash value, which, as I said before, was the equivalent of the premium plus any other interest that had grown after year 6, 7, or 8. We would allow them to access Ben's cash value, and we would waive all withdrawal charges. So there's no withdrawal charge if they need money out of Ben's contract on the cash value side of it. We're not talking the death benefit. We're not talking the leverage. We're not talking the 90%. We are talking the cash value out of Ben's policy, which was the premium amount plus any cash value interest it had grown to at the time of claim. So we would allow them to take the cash value for Betty's needs. Okay? So this is a situation where they no longer have to be concerned that they put all the resource assets on a policy for Ben because there's still access to it in the event that Betty becomes terminally ill or chronically ill. All right? So I think there's only one other contract in the industry right now that offers that type of a benefit. But I believe, well, I don't want to say, but I know this. Betty doesn't even have to be named on the contract. She doesn't have to be the beneficiary. She just has to be Ben's spouse, okay? And I had a question on this last week. Somebody asked me, does that include domestic partner relationships? As long as they're recognized by state, it qualifies for us as well, okay? All right. So the last of these scenarios would be, for our conversation today, would be about Walter and Donna. And in this scenario, both Walter and Donna buy one of these contracts. Let's say that the family together has $100,000 in one of these idle assets. So they put $50,000 on Walter and $50,000 on Donna. It buys leveraged death benefit. Well, the reason why we would do that is so that we get this double dip effect, so that if Walter becomes terminally ill, he can get 90% of his own death benefit, but then he can get access to Donna's cash value based on the withdrawal feature and the waiver of withdrawal that we just talked about a moment ago. So he has access to two sources of money: the leveraged up value of his own life insurance with the terminal illness rider and the cash value added Donna, and vice versa. So if Donna were to become terminally ill, she has the access to her own leveraged up death benefit of 90%, and then she has access to Walter's cash value by way of the waiver of withdrawal charge. So it's kind of a double dip situation, and that's what the ice cream double dip is all about on the illustration here on the slide. So these are our opportunities really to place this and put this type of a policy in place and answer clients' questions about how am I going to get to my money if I need it. So how easy is it? We have 5 medical questions. There's only 1 underwriting class. It's easy to calculate. We have a 1-page little calculator that has a chart in it. It's a leverage chart. And based on the deposit times the factor on the chart, that tells you how much leverage is by age. In regards to the medical questions, when we take a look at those here in a minute, if a client answers no to our 5 medical questions, 97% of the time we can provide an approval in 10 minutes. 10 minutes, the client will know if they're eligible for this wonderful contract that you've done all the effort in presenting to them. And we pay commissions on a weekly basis. So it's very much like an annuity sale as far as the way the compensation is set up, because it's very transactional and there's no time built into getting the case issued. So here are the 5 medical questions. All right, 5 medical questions. Here's what I really want you to focus on. I want you to focus on what's not here, and then I want you to focus on the last one of these questions, question E. Question E says, have you been declined, refused, or turned down for life insurance? If it's been long-term care insurance, we don't care. All right? If they've been declined, refused, or turned down for life insurance, that's going to show up in MIB. Okay? That's going to show up in MIB. And that's the only check we do is MIB. So if for any reason they answer no to all 5 and we pull MIB and there's something in MIB, then we have to ask more questions and we have to wonder why. So really the whole strength in this questionnaire is don't ask more questions than you see on this questionnaire. Ask exactly what you see on this questionnaire and make sure the answer to question E is no, if and truly they have not been declined, turned down, or refused for life insurance. Okay? So what's not here? Again, what's not here, in this particular version, this particular year, this particular product only, in this product only, we don't ask for height and weight. We don't ask for HIV. Okay? We don't ask for tobacco usage. We don't ask about high blood pressure. We don't ask about cholesterol. We don't ask about anxiety medications, depression. We don't ask, again, about diabetes. We don't ask about specifically Parkinson's unless Parkinson's has led to some kind of dementia in question C. Okay? We don't ask about muscular dystrophy. We don't ask about occupation. We don't ask about hobbies or avocation. So there's so many opportunities for us to get a case issued and get through underwriting because of what's not here if you stay true to the 5 questions that are here. And if you do happen to have a yes answer, we would ask you to provide us some information on a cover sheet so that we can explore it a little further and determine if we would still issue it. We may not issue it or give you an approval in 10 minutes, but if you can provide us some information, we can decide whether we should probe further or if we could approve it at that point. Okay? So people always ask us, well, is a yes answer a knockout? And the answer really is depends. Okay? And it depends on if it's specifically in regards to question C about heart attack, stroke, mini stroke, cancer, Alzheimer's, those kinds of things. All right? So it depends. We get a lot of questions about number B, which is the cancer question. Well, what about skin cancer, right? What about that with my squamous cell, and what about that with my, my non-carcinogenic skin cancers, those kinds of things? Those we will issue. Okay, skin cancer is not a knockout question. So it's a situation where we would like to look at that with a little bit more understanding and explanation situation. Okay? So, mind you, just ask what's here and be particular about question E, declined, refused, or turned down for life insurance. And if these are answered no, that's it. Don't make it more complicated than it is. Submit the application, and in 10 minutes we can get an answer back. Okay? I know there's going to be some more questions around that. So we'll take a minute here and entertain some of those questions. Okay? So, Mike, if you want to open the phones, or if you saved any that have been, text to you, let's go. Let's have some questions.
I'm unmuting everybody right now. Again, if you haven't entered in your PIN code, you're going to need to do that if you want to ask questions. We're going to take questions with Carrie here for a few minutes, and then we'll bring on our special guest to talk about the lead gen program here once we get done with the main part of the presentation. So got most everybody unmuted. I know that there are questions out there, so let's go ahead and fire away. Now that you are unmuted, if you don't have a question and there's any background noise on your end, if you'd be so kind as to individually mute yourself by hitting *76, everybody would appreciate that. So let's go ahead.
Let's go.
Hi, this is Carrie. Someone have a question?
Jensen, I know you're out there. We've talked some about this kind of stuff with regard to long-term care declines. How do you see this being able to fit into that kind of a scenario for you?
Well, I certainly think that it'll work in some circumstances. That's my first impression. I want to learn it much more soundly.
Okay. Well, we do have the PowerPoint in everybody's email inbox now. I sent it out right before we started this morning, so you'll have a chance to go back over this, and of course the recorded version will be posted on our website. So, all right, any other questions out there?
Yeah, thanks, Mike. I already downloaded the PowerPoint, and I'll go through it in detail.
Great. Okay, great. All right, well, it's looking to me like you threw a no-hitter, Carrie. That's not a bad thing on a Friday, but we'll make sure, we'll circle back here one more time and make sure that if anybody does have questions that we can take care of that. So,
very good, and I appreciate the time. You know, the thing that I think is the biggest question for most producers is, how do I find the money? How do I have that conversation with the client and find this kind of money that we're talking about for single premium? Again, remember, minimum of $15,000. So you'll be surprised if you ask clients if they have money that they really don't intend to use. It's sitting in their checking accounts. It's sitting in their money market accounts. It's sitting in CDs. We will take 1035 exchange money from one life insurance company, cash value, to this contract. So if you're having conversations about long-term care and where are your assets and where is your wealth and how do you plan to pay for long-term care, it's the same conversation you will have to find out if there are those type of idle assets that are better positioned for wealth transfer in this estate maximizer next gen. So that's my parting comment. I do appreciate the chance to talk with you folks today. And Mike, if any of your folks want to call me directly, I'm okay with that on a one-on kind of a question situation. My phone number is area code 603-970-7064. That's a Dover, New Hampshire number, but I'm located in California. So I'm on the same time zone that the rest of you are. If you're here on the West Coast, that number rings right into my home office right here in my house. So I'll be glad to take any questions anytime. My email is Kerry, Kerry .Ainsworth, AINSWORTH, at libertymutual.com. If you just want to shoot me a quick note with the question, I'll be glad to answer it that way too. Mike, thanks again. Appreciate everybody's time.
Appreciate your time. Okay, take care. Have a good weekend.
Thank you very much. Bye-bye now.
All right, now we're going to switch over, and we're going to spend some time now talking about our new lead gen program. And joining us this morning to help us in that endeavor is the president of the 3 and 4 Association and a good friend of AIM, Jonas Roser. Jonas, you out there?
Here, Mike. Can you hear me?
We can.
Okay.
Welcome.
Great.
Thanks for your time. The
No
3 and
problem.
4 Association has a great lead gen opportunity that they're making available on an exclusive basis to AIM agents, and that's why I have that website here. Jonas is going to talk about it a little bit and give you the basics on how to go about taking part in that. So go ahead.
Okay, and just to double check, are you talking you have the 3 and 4 website up? Is that the one that you have up, Mike?
3and4needmore.com.
Okay, great. Well, welcome everyone, and thanks for giving me an opportunity to talk to you about the 3 and 4. And if you've heard me say this before, bear with me, but I do know that we have a great platform, a great education campaign that has a great licensed lead generation program attached to it to support producers such as yourself. Right now, the lead generation that we're offering through our third-party licensed vendor is for long-term care insurance. We have critical illness lead generation coming and some MedSup and a few other products. But right now what we have tested that's doing extremely well is long-term care insurance. We have a handful of different creatives. I can tell you they're pulling a 1.3% nationally, but it's extremely high for long-term care insurance, especially when it says a licensed insurance agent will be calling you on the lead. We believe that the reason our campaign is pulling so strongly is because we are a nonprofit that is out there educating to consumers on the need to form a long-term care plan, and we put emphasis on products and services that should be considered in long-term care planning. The website which Mike is talking about is www.3in4needmore.com. That's the number 3, IN, number 4, needmore.com. You can read about the association there. And what we do is, once again, we highlight products and services that should be in a long-term care plan. This is one way. We have put together a strong mailer that talks about the state partnership programs, Target Leads, which has been around since the 80s as a great lead generation. Letter Shop has the ability now to mail out per 1,000. I believe it's $500 per 1,000. So you're able to pick the criteria you want for the households you want, by the zip code you want. You get an automatic subscription to their online lead platform where you manage your leads. They come to you and only you. They mail out first class, so usually have leads back probably in 5 business days from the time of placing your order. We've had response rates as high as 4%. And once again, there's a whole education campaign connected with this. This isn't just sending out direct mail. There's national TV spots that are playing on long-term care insurance from the 3 and 4 Need More. There's a guide that we offer as a fulfillment piece, which you can offer as well. You can offer it electronically, so there's no fulfillment cost in doing that. And that's offered on the lead gen piece. And it's about 16 chapters in there, each covering a different kind of product or service around a long-term care plan. That in connection with all the other outreach we've done, from bus tours to radio shows and whatnot, really gives the consumer a heart. There's no hesitation for them filling out the card and requesting more information or having an agent call them, because they know we're here to educate. I've been told that there's at least 4 agencies that are supporting their entire career force on using this creative for long-term care insurance, and I'm seeing our numbers go up drastically week over week from orders. So it is a new program that's doing really well. We tested it for about a year before we started selling it in the format that it is right now. And I'd love for you to go to 3and4needmore.com to learn more about the association. That is the consumer webpage. When you're there, you'll notice it says Become an Advisor in the tab titling at the top. You'll click that. It's free to register at the 3 and 4. Once you've registered, there is a pay annual membership of $60. Now that $60 enables you to be part of the mailing program. It enables you to private label all the materials. The book, as I talked about, you can have your picture, your contact information on the back. Gives you access to our seminar program and the PR that goes along with it, all the templates. We have a LTCI state partnership seminar program that's doing extremely well on the worksite. Once again, being part of the 3 and 4 enables you to ride on the coattails of our nonprofit education message. So that partnership seminar program is enabling producers to get in the worksite. They call up an HR manager and let them know that they have a 30-minute presentation on long-term care planning provided by the 3 and 4 Association, which is a nonprofit. And now you're getting in front of people at their place of work, so you're usually getting a lot of people in seats. All this money goes back into developing marketing campaigns. There's no paid staff members on the 3 and 4, so that $60 really means a lot to us. And it's $5 a month, so it's a price of 2 cups of coffee. And it's going to create what we see as kind of the Got Milk campaign for long-term care insurance. So I hope that you can go about the consumer web page. Hopefully you can see things there. Make sure to click on all the tabs. You can see the LTCI commercial that's playing, see the resources we offer a consumer, and then please join and become an advisor. At least join for the free membership so you can be part of our email blast and know what we're doing and where we're offering more things. And any questions, if you'd like to email me, my email is jonas@3and4needmore.com. Mike, did I miss?
Right. No, you didn't miss anything. That was good. I went ahead and walked everybody right to the website. We're actually looking at the register form for the advisor portal. Once you get into that registration, then you'll have the opportunity to be a dues-paying member, if you will. And from there, then you have the opportunity to access the LEAD program. Again, it's like Jonas said, it's $5 a month to have access to it.
I just want to show you one more thing, Mike. If you could just click the home button. And once you're on the home button, see the 1, 2, 3, or 4 buttons in the middle, below more, and just the names with the sliding tiles.
Yeah, I'm looking at it right now.
Okay, click number 2.
Okay.
And then number 2 is going to bring, and then once you click number 2, oops.
That's Dr. Marion.
Yeah, I wanted to get to, I wanted to show them where the, I'm trying to remember from memory, where the LTCI commercial is so they can actually see it. I think it's in Outreach, actually. I'm sorry. Yeah, I'm sorry. If you click Outreach,
okay,
they'll drop down. You'll see the 2. It says long-term care insurance.
Right.
Those are the 2 commercials that are playing nationwide right now. They're
playing
the
PSAs by Dr. Marion. Yeah, okay. Yeah. Perfect.
So this is what's great because part of being with the 3 and 4, the money that you're paying for memberships goes to do things like this. This commercial is talking about how important long-term care insurance is. And then it drives, it says for more information, to find a specialist, go to 3and4needmore.com. You'll notice if Mike hits the home button now again, if you look at he's going to scroll down, it says find a local specialist. And you're able to then, a consumer can look up a specialist by zip code. And there's also the drop-down bar. So now they can find an annuity specialist, critical illness specialist, financial advisor, insurance carrier, life insurance. There's different categories here. This is all also connected with our smart app. So this membership, $60 a year, gets you listed on a web page that has traffic being driven to it from commercials, and also then ties in to our smart app for an iPhone and iPad. So another great ways for consumers to find you.
All right, very good. Thank you, Jonas. I want to give anybody that's out there that has questions a chance to go ahead and pop in with those. It's a pretty simple and straightforward program. Great. I can tell you, having done this for a long time and been in the direct mail business, the return rates that Jonas is talking about are gigantic compared to what you typically see out there. If you're lucky, usually you're lucky to get 0.5%. He's talking north of 1.5 in some cases. Obviously, it's going to depend based on geography, but it is a great opportunity, and we know from experience that the one thing agents are always clamoring for is leads. So that said, and with respect to Jonas's time, any questions? Okay. Well, you've got his email address. If anything comes up, you can also reach out to us here at AIM. And again, the website, numeric 3 in numeric 4 needmore.com. 3 and 4 needmore.com. I'd highly suggest, no matter what else you do, get on there, get yourself registered as an advisor. Take a look around. I would say the $5 a month to take part in the program and have access to the resources that are available there is a pittance to pay to be active in this vibrant and very necessary market right now. So we do have a question. Let's take a look here. Is there a list of areas where the commercial appears?
So here's what I can tell you. The benefit of being a nonprofit is we get certain marketing concessions. So we pay to produce the commercials in the same format as any other commercial, but we actually submit them as public service announcements. We submit them nationwide to every single TV station and network. We believe, well, actually, I know that ours is playing in the top 5% of PSAs nationally. So it's getting played quite often. I tracked it for the first month, and what it told us is that we would have paid $1.2 million for how many times it aired in that month if we were paying customers. Due to we have a limited budget, I only tracked it for the first 4 weeks. So I guess long story short is I can't tell you, I could go back to tracking report and tell you where it's playing the first 4 weeks. I can't tell you where it's playing now, but I can tell you we send it to everywhere. And by law, a TV station has to play so many public service announcements every single week. We believe that ours has resonated so much because the marketing that we put involved with, we told them that it affects 3 out of 4 of their viewers. And that's the one powerful thing with it for when you guys go to market it. It affects 3 out of 4 of their members, 3 out of 4 of their employees. You're able to take it because it's based off the Health and Human Services statistic that 3 out of 4 people need some form of long-term care at some point in their life. And being prepared for that, the long-term care plan is the appropriate thing to do. So once again, nonprofit messaging based off the Health and Human Services statistics tied into national TV, tied into a smart app, tied into a consumer website that ranks page 1 for the term long-term care planning. If you put long-term care planning into Google right now, you'll see us land on page 1. The only other stuff that's there is paid stuff and government sites. So once again, great way to be connected to all those activities for a very small amount of money. And if anything, think of it as funding to get the education program out there that makes it very hard for carriers to do because of the levels of compliance that they have.
I'm finished.
All right, great. Thank you. Any other questions out there? Okay. Well, folks, we appreciate your time this morning. As I said, you've got Jonas's email address. If you need anything else, let us know here at AIM, and we will look to see you on another AIM webinar very, very soon. Jonas, thanks. Have a great day. Talk to you soon, folks.